G'day expats and welcome to another episode of Expat Chat, episode 123 today. And I'm welcoming my friend, mate, colleague, mentor, business partner, Brett Evans, who is over in the sandpit and the managing director for the EMEA region. He's coming back to work from having a bit of man flu and recovering. He still looks a bit ordinary. How you going, Brett?
Mate, I got the ambulance downstairs on standby, so please don't be worried. But yeah, it's just it's gone through the house, gone through Dubai, and as the
Yep.
school nurse said to me when I picked up my oldest daughter, who also had it, they call it the holiday flu because everyone in Dubai doesn't stay here in summer, and when they
No,
fly back in
they,
for the
they bring it back.
term, they bring it back. So the gift that keeps on giving, my youngest daughter had it last week and my oldest daughter and I had it this week.
Oh,
So,
God.
mate, the expat chat will always go on. I've dragged myself in here to work to just record this and
Absolutely.
we'll hopefully help the listeners get a bit more information. And we're going to talk about a very emotive topic today. But before I go any further,
Oh,
to
yeah.
the folks who are new to the podcast, g'day. And to introduce my colleague on the call, Mr. James Ridley, is the Managing Director for the APAC region, and you know, he's my partner in crime in a good sense. The compliance officers out there, we're not committing any felonies, no crime, but yeah, it's nice to have a someone with me on this journey of trying to educate and empower Australian expats to grow their finances and make smart decisions.
That's it, mate. And I mean, today's topic, it's pretty important.
Juicy.
And it is juicy, and God, a lot of Australians, they love it back in Australia because it helps reduce their taxes.
Yeah.
Negative gearing. It's actually received a lot of I guess airtime, I would say, just in the 24 hours. You put in negative gearing and all the news articles have jumped on it. And I think whenever we're coming into election, negative gearing, it's always around and what's being talked about as well. And then there's always things about franking credits, refunds, trust distributions, all the hot topics. Stamp duty gets a run, but that's obviously a state one. So what a great topic to talk about, layer it through an expat lens as well, and jump into it, mate. So why don't
Now
we?
let's get the disclaimer out of the way. All the information we're
Sounds
going to
good.
have a good chat to you, good guys and girls. Today should be treated as information and educational purposes only. Please do not construe this as personal advice. If you do need to get personal advice, speak to a specialist like Atlas.
Absolutely, mate. Negative gearing. I think we need to probably define it for our listeners, what it actually means for those that haven't heard of it, don't understand it. I think we jump in and just explain how negative gearing actually operates.
Yeah, mate, good one. So negative gearing came in, believe it or not, in 1936. And yeah,
Jeez.
quite a few years ago. And it wasn't actually around property. It was just around if you create a loss on an asset in that financial year, you can offset that loss against your income, and that
Mhm.
reduces down your assessable income. So in a very sort of simple sort of way, if you earn $100,000 a year and you own an investment property and that investment property costs you an extra $10,000 that you have to out of your own pocket pay for to fund the difference, then your assessable income comes down to 90,000. So it's
That's
very
right.
simple. And the Australian property market has relied heavily on negative gearing as a motivator. You know, the amount of people who buy property not because it's a good investment, but because they say they're paying too much tax and they want to reduce that tax. It's negative economics. It's hilarious. It's that sort of, I'm paying too much tax. I'm going to put money out of my own pocket to spend just to get it back. So they haven't
Mm.
actually changed anything, but the idea behind it is it helps you buy property or properties that on paper aren't a good investment from a cash flow point of view, with the
Mm.
hope of capital appreciation and also paying
Mm.
down debt being the funding vehicle. Now, I think it's
That's
also
right.
important to say expats can't do negative gearing, so let's just get that out there. But the latest rumour mongerings and stuff coming out of Canberra, it will affect expats in terms of, will Canberra go ahead with a review of negative gearing by Treasury, and will they take it to the election? And if they do, will it push property prices up or down, or will it push rents up or down? So, mate, I'll open the floor to you, and let's hear
Yeah.
what good espousings you have.
Yeah. Well, I mean, You've hit the nail on the head, and unfortunately, I think from negative gearing, you've also had a lot of property spruiking companies and mobs, which are more sales engines, come about, especially in the last 30, 40 years, where they're flogging, I suppose, off the plan property in the middle of nowhere, maybe even near mining towns, and then, because you might be doing a very cheap build, dual occupancy homes, those sort of things, there's big depreciation benefits. So, you get it rented and that it is negatively geared, but then they spruik it as, cash flow positive properties, and you're only getting the cash flow from the tax refund after you've lodged the tax return. So they're not usually good investments. Residential property, as we know, doesn't usually give us really good income yields. Usually leveraging it so you get the capital growth, but you need to be smart enough to know where to buy. And if you're not smart enough, then you seek advice to buy the right kind of ones. So that's an important one. Negative gearing with expats, though, it doesn't exist. The reason it doesn't exist is because you don't have someone back in Australia paying tax on your behalf. Often accountants will refer to things like this as if you've got a negative geared property, you've got all these tax credits as well. And there's a bit of confusion around that because they're not tax credits. And I guess what the account's often referring to is the income loss, that you might have accrued from that negatively geared property, which then gets carried forward into the next financial year and then the next financial year. And unfortunately, some accounts do refer to it as tax credits. And then every now and then I'll speak to an expat client, or I'll come across a new Australian expat that's just moved overseas, and they say they've got all these tax credits built up. And then I deep dive into their tax returns, and then it's like, hang on, you've got losses here. If we had credits, that would be great. But these are just losses. You won't actually get to use these again until you eventually return back to Australia. And then, funnily enough, a lot of clients, when they return, are going to be retired, and most of their retirement assets are in super. So they actually won't pay tax again. So it means that they probably haven't been running maybe the best strategy. They could have probably used some of their free cash a bit wiser. But yes, going back to negative gearing as a whole, it doesn't really apply to Australian expats. You're accumulating income losses, but you're not getting the tax benefits until at some point in the future when you return. And then, you can use it either to offset some sort of income, like a wage income in Australia, or if you have a big capital gain, you can use that income loss to offset the capital gain. I think there's always a bit of confusion around that as well, and I'll probably save that for another episode about capital gains, capital losses, income losses, those sort of things.
I think it's a good idea because we can go down a few rabbit holes here, but I think today we'll just focus on, let's say Labor does get in, let's say they do take Treasury's feedback on board and change, obviously, negative gearing somehow. What will that do to existing people who are using negative gearing, and what will it do you think, to the property market in general?
Well, I mean, if they remove negative gearing completely, if that ever got through, often what we'd find happen is that they would grandfather any sort of pre-existing properties as part of the old scheme, and that's often what these get referred to as old, tax schemes, those sort of things. And you'd still get some sort of negative gearing benefits from those, but it would mean after a certain date, any new properties that you're purchasing, you're unable to negative gear. So that would mean that if the tax deductions are more than the income, you just won't get to carry forward the loss. So it would reduce your income down to, say, nil on the property asset, but it means it doesn't go any further below that, so it doesn't offset your wage income or other passive income sources. That's probably the cleanest way that they would try and implement it, because then you're not getting the negative gearing benefits. The property that you're running from a tax position is essentially just breaking even and not technically able to run at a tax loss. So you're missing out on those benefits. That's really common. They have changed in the last couple of years depreciation benefits on what you could claim. So often right now, when you think about depreciation, and I guess zooming out, what is depreciation? Quick high-level summary. Depreciation is just the tax claim on the decline in value of either any fixtures and fittings or the building or the property itself. So often that's a really big tax deduction, but a few years ago they changed the depreciation benefits that you could extract from each property. Depreciation is a double-edged sword as well. Whatever you're claiming year on year will come back and reduce the cost base when you sell it. Often a lot of property investors forget that, and they go, oh shit, I've been claiming depreciation for 15 years on this property. What do you mean the cost base has now dropped to XYZ, so the capital gain's more? So that's another thing to be mindful of. But often with these kind of changes, if they ever get through, it's a case where it'll be grandfathered. But when you think about negative gearing, even if this got in tomorrow, the housing crisis in Australia is a multi-generational issue. It's not something that's going to be fixed in the next 10 years, maybe not even the next 30 years, to be honest. They can't build quick enough based on, I guess, the housing supply. They need I suppose, just some sweeping reforms, to be honest, to make it a lot easier. There needs to be more government funding to help that, buy to let or buy to lease or buy to rent, those sort of things. There's not enough being done to support the current housing crisis, and these things are often too slow. We always find around election time, these are the common talking points, but they never get put through at all. I think I was reading the Grattan Institute's negative gearing report that it did back in 2018. I've got up in front of me, and some of the changes they were recommending as part of the negative gearing report, they wanted to reduce the capital gains tax discount for individuals. Right now it's 50%. They want to knock it back to 25%. They wanted to look at putting a cap on the main residence exemption. So that doesn't apply to Aussies that are overseas right now. But in the US, they have a main residence exemption equivalent, but they've got a cap on it for capital gains. It's either 250,000 USD for the capital gain portion for an individual or 500 for a couple. So there was a suggestion in there to reduce that capital gain exemption, which means there would be more tax being paid. I'm not sure how that would incentivize the housing crisis, because that's just a form of revenue raising for the government, and probably the state-based government as well. And then there's always talk about the removal of stamp duty or reducing stamp duty, because we are one of the only countries which really taxes you heavily for selling your old property and upgrading to a large property as maybe your family grows or you move somewhere else. It's an extra 1-2% when you're buying a new property. So there's a lot in this around negative gearing.
And I think you're spot on. And to me, if they did make any changes to negative gearing, I agree it'll be grandfathered for those existing people, because otherwise there'll be a lot of folks out there cash flow negative who will have to start dumping properties, and that would have a pretty bad experience with in the property market. But to me, it'd be more prescriptive, and I think they're not targeting the mums and dads with 1 and 2 properties. They're targeting the people who have 5, 10, 15, 20 properties. You see them on the articles all the time, 25 years old and $15 million worth of property. What you don't see on the other side is they got $15 million worth of property and they got $14 million worth of debt. So because as the property grows, they go to a conference, in some RSL hall with we all know the names of the normal spruikers that do their rounds, and they'll say, hey, your property's gone up 100 grand, take 50 out and use that as a 10% deposit on the next one. And then they just keep doing that, repeating it. They're actually not paying down debt. They're actually, or building up equity. They're just spreading it over a greater side. One of the arguments to say that if they did get rid of negative gearing, it would actually drive up interest rates. Drive up rent. And the reason being is with rent, the way that works is obviously you take money in as a landlord to pay your bills. If suddenly you're now $10,000 a year out of pocket, therefore you'll need to recoup that back somewhere with no tax benefit. So suddenly you could put up your rent by, $833 a month, because by doing that, that'll plug the gap. So now there's that side of it as well too. I think I can see, this is the third time it's come up. 2016 election, 2019 election, obviously 2021, that was COVID time, so that was a bit of a free kick with Albo. But the fact it's come up again, to me, it's almost like what we call a triple top in equity markets, where it keeps trying to hit those tops, and the third one, it often breaks through. And I think this one will have traction. I really do, because property, if the punter who's voting for either party at the election perceives that this is going to reduce the impediments to jumping on the property ladder, then 100%. There's a perception with the younger generation that the older generation's geared to the hilt and they've got all the properties, and negative gearing's the cause of the problem. So if you're Labor and you want to play the young vote, it could be interesting there too. I think the other thing to consider in the back of everyone's minds too is, if they did make a change, this is one of many pillars that Australia has to fix in the property market. Second one is obviously red tape, regulation, all those things.
Mm.
Developers are cutting back in their developments. They're not doing as many developments as in the past because they're just tied up in red tape. The time it takes, the cost, and all those experiences. And this is at the local, state, and federal level. So there needs to be a review on that side as well too. And the last one has to be, always around the government propping up this sector. Because I think it's the last time I saw, I think it's the fifth largest sector in the Australian economy is the property sector when it comes to the tentacles that it affects. Whether it's artificial, whether it's putting a safety net underneath it, to me, there needs to be that ebb and flow of the property market, which we haven't had in the last 10 years. It's just been on a tear the whole way. It needs to have, like equity markets rebalance instantaneously. If something happens, pressure comes out, prices settle down, then it goes again. Whereas the property market, we haven't had that. It's like a slow burn. And we're seeing that as we speak right now with interest rates being kept where they are. It's death by 1,000 cuts with a lot of folks out there who are struggling to get by. So to me, I do think this has merit. I think it's one of many pillars that has to be addressed. I can see them capping MRE, the main residence exemption when it comes to CGT. It's a hard ask when someone pays $50 million for a place in Point Piper as a PPR and then sells it, 2 years later for $70 million, and they've picked up a $20 million gain tax-free, isn't it? Fantastic. You'd sell all your assets and just put it into that, wouldn't you?
Wouldn't you?
But, to me, there's those areas. I think if they want to do true tax reform, which I think they have to, they need to look at this thing not just from a negative gearing perspective, but from all other areas. Because when you're an investor, the way you make money on a property is on the way in, the price that you pay for a property. You can't change that. If you pay $1 million for a property and it's 100,000 too much, guess what? You can't revise it down or you can't adjust it. You've just paid too much for that property. And people are relying upon the tax side to offset, they're sort of saying, well, it's going to cost me this much money, but the government will give it back to me anyway. And I think the numbers that I saw recently was like $30 billion a year it costs the government in terms of, credits getting back to investors. So I think there's merit there. And if Albo plays his cards the way I think he's going to play his cards, he's going to say, we're spending $30 billion a year on negative gearing, tax allowances. If we cut that back down to 15, that's another 15 we can put into hospitals and schools. So you can see how that side's got to go. I think everything's on the table right now. Already there.
God, it'd be a huge piece of reform, but I think it would take time. I think you're right. I agree with you. It does need to update and change. And I mean, I guess our whole tax system needs a bit of a reform, to be honest with you, about our income tax rates compared to other countries, and then VAT and GST, all those sort of things. It does need a bit of improvement. Negative gearing take a while to actually implement. I don't mind what you said there about 30 billion, but if they reduce it down to 15 billion. So, on the surface, they could still have negative gearing to a degree, but wind it back. Say, okay, because of your loss, you're entitled to a 10K refund, but as part of this new legislation, we're only going to give you half or 25% of that refund because that's where we're capping it. So you still get some tax benefits, but not everything. It means ATO or the government's keeping a lot more in their pocket, but they can drive that into, further developing things. So drive it into a lot of infrastructure, improving a lot of systems. Everything's a bit slow still in Australia. But yeah, I mean, and going back again, those of us that are obviously overseas, expats, negative gearing, it's not really a strategy that you can use either until you're back in Australia, and you're using those accrued losses. You can't sell losses. That's a funny question I've had before. A client's asked me, I've got a couple 100,000 in income losses. Can I sell that to anyone? I was like, no. If it was in a company, that could be a different thing. But if it's in an individual, no. You don't lose losses though. Losses can actually carry forward indefinitely. So maybe that's another thing that the ATO changes. Says, hey, listen, if you haven't used this loss by within 5 years, it's gone, kaput. Therefore, that's going to obviously piss off a lot of people as well. But there's many shapes and forms that this potential legislative update could change.
Look, I think, and to me, it'll bring things back to its roots, which is what it should be. If you're looking to buy a house, is the house a good investment? Does it pay for itself? Is there capital appreciation? No different to buying any other commodity or asset. Whereas a lot of people look at assets from a property point of view and say, oh, look, it's okay. It's behind by 10 grand a year, but that's right. Negative gearing will cover the gap. So maybe there'll be either rents will go up or property values will go down to try and bring the yield
Yeah.
up. I don't know. Or might be both.
Yeah. Yeah, I agree. It's a tough one. I mean, residential property, you don't get yields from it at all, let's be honest. Commercial property is where you might find yields, but owning a commercial property when you're retired, it's a slippery slope.
Low capital appreciation too, commercial.
That's right. Yeah, and just also mean it in terms of the potential big costs you could have with a commercial property, and you're retired, so you got no wage income to help you. So you're like, fuck, all right, I've got to dig into my retirement asset, my other retirement asset, my super to fund this big expense and fix or maintenance or repair. There's a lot can go wrong. But I think we've done this topic to death, and we could keep going.
And I think so. I think we'll wrap it up there. Just a bit of housekeeping for folks out there. Those living in the sandpit, Riyadh, Dubai, and Abu Dhabi, we do have those seminars, I should say, coming up in a couple of weeks' time. So, and you guys, yourself, Jeremy and Ben will all be over here. And, looking forward to giving you guys a cook's tour of, obviously, the UAE and especially Saudi, because you haven't been there before. So,
nice.
the Wild West.
That's right. Saudi would be good. I'm looking forward to seeing how much Dubai and Abu Dhabi have changed in the last couple of years, because I know that's how quick things change over there.
Blow you away.
I think Jeremy and I will be in for a rude shock. I'm looking forward to Ben getting over there because it's the first time he's actually been over in the sandpit before. So there'll be a lot to show him.
Yeah. So there'll be a link down below, guys, to our events page. All those events are on there to register. Please do register. And the reason I say that is because we do have a limited seating. Obviously, the rooms are only so big and they are filling fast. And then this is not some sales ploy and stuff. We're in Riyadh, we're almost full. So as an example, in Abu Dhabi, we're almost full. So, and Dubai is the latest one to be released. So that's not full yet, but that'll fill up very quickly. So make sure you get out there, guys. Make sure you register those events. I promise you, it'll be time well spent. We got to put some grub on, throw a few drinks around. Obviously non-alcoholic in Saudi, but there'll be some alcoholic drinks in the UAE.
Tea and soft drink.
So it will be beneficial to everyone to get along to these events, because if it's just about the mortgage side, you'll hear Jeremy. If it's just about the tax side, you'll talk to Ben. The investing side, the financial planning side, we've got it all covered. And to me, it's the first time in this region that this type of event has ever been presented and produced in this region, because obviously I do talks or Jeremy does talks, but not all four of us giving the lay of the land on every single topic that an expat needs to consider.
Absolutely, mate. I can't wait to get over there. Flying out next week. It's going to be great. See you all there. Jump on the events page, register, especially having the nibbles beforehand. I love hearing everyone's stories, all walks of life. It's great.
Yep. No, Aussie Expats doing pretty cool stuff.
Absolutely, mate. All right, guys. Thanks for tuning into this episode, and see you on the next one. Thanks, Brett.
Thanks, mate.